On Small Cap Power, we have Michael Sprung, President of Sprung Investment Management. Michael, thank you for joining us at Small Cap Power.
Well, it's good to be here. Thank you very much.
So now that Donald Trump is president, what sectors are you interested in investing in, and also what are you avoiding?
Well, I think that I'm interested in companies that are going to do well because the economy is doing well, regardless of who is president. But we have seen the U.S. economy expanding of late. There is hope for rising interest rates in the future. And, you know, in that environment, I think that insurance companies are going to certainly do well. They tend to do well in a rising rate environment, particularly over the longer term. More immediately, banks will benefit from that, but banks will particularly benefit from an era of deregulation. So I think, you know, those are two areas that I really want to focus on. Beyond that, it's going to be taxes, if tax rates do in fact get lowered in the U.S. a little bit. Certainly consumer durables, consumer staples, discretionary spending should pick up a little bit. Beyond that, I think that we are in a wait-and-see attitude. There's been a lot of talk about changes in trade policy, renegotiation of trade. That's going to affect an awful lot of manufacturing companies as well as companies that distribute materials around the world. So I think that we want to be a little bit picky as to where we invest in those sorts of industries. Other than that, I think that it's fairly safe to say that the talk about infrastructure spending is very long term. It takes a long time to see the results of that, particularly for it to roll through into the economy itself. So I'm a little bit of a skeptic in terms of jumping on the bandwagon for infrastructure spending at this point in time.
Right, and your outlook for Canadian and U.S. equities for this year?
Well, my outlook for equities is really sort of balanced with my outlook on what has happened over the last year or so. I mean, last year I would characterize as a year of surprises. I mean, 2016 was a year in which a lot of things didn't work out the way that the experts said that they were going to. You know, we saw that with the Brexit vote. We saw that again with the Trump vote. In both cases, people were calling for the opposite to happen compared to what really did happen. They were also saying that markets would go down as a result, which, you know, for a few days they did after Brexit. And then, you know, the Trump was almost more immediate. So I think that going into 2017, we're still carrying a lot of the geopolitical baggage across from prior years in terms of the financial situation in Europe. We've got the migration crisis in Europe. We've got problems in the Middle East, particularly Syria. We've got problems in the South China Sea. We've got Russia making moves within the Ukraine and in Syria. All of these things carry over from prior years. I think that we're going to see as many surprises this year as we saw in prior years. We're seeing now within Europe itself more sentiment that is anti-free trade, anti-globalization. You know, people are worried. Technology has caused a lot of dislocations in jobs, and it continues to do so at an accelerating pace. But, you know, putting up trade barriers is not going to fix that. It's not going to bring jobs back. So I think one of the biggest concerns going forward is that the movements to sort of limit trade, which is really the oil that helps markets function and grow, is going to impede. And that's layered on top of the fact that we've seen valuations rising over the last while at a much faster pace than we've seen earnings. So that's another reason why I think investors have to be extremely careful as how they invest over the next period.
Right, and how can investors also be expected to have effect with France anticipating a new president and calls for potential Frexit?
Well, you know, I think rather than Frexit, actually, Marie Le Pen's been talking about trying to reintroduce the franc, which is hard to see how it can be done within the context of staying in the EU environment. But I think that it certainly is going to worry the markets. You know, we have several elections coming up in Europe this year, and every one of them there seems to be more of a radical sentiment growing.
Right, exactly. Now let's talk about what stocks you like at this time and why.
Well, earlier I said that I liked insurance stocks, so I'm going to, at this point, center on Manulife. I think that Manulife Financial, which is one of the leading insurance companies in Canada with extensive operations both in the U.S., where the economy is doing quite well, and very quickly growing operations in Asia, will benefit, particularly in an era of rising interest rates, as we were talking about before. So I would certainly think that that is a place that people can invest, particularly since over the last number of years they've taken great strides in strengthening their balance sheet. They're probably the best capitalized insurance company in Canada. And in the meantime, they're carrying a yield of around 3%, with the possibility, as profitability grows, for those dividends to grow as well.
Really great. And do you have any top value stocks at this time?
Well, I like AGT Food and Ingredients. Now, it's a little bit smaller. It's under $1 billion market cap. But, you know, they are a leader in pulse processing and distribution. They are expanding operations more and more into food ingredients, both for human and for pet consumption. Pulses have really grown in demand as global demand for proteins has increased, and not everyone eats grains, and so pulses have taken a lot of that market share away. And you know, I think in the meantime, this is a very quickly growing company. They are expanding their capacity, and in the meantime, you're getting about a 1.7% yield, which over time could grow.
Well, thank you for that. And my last question is, what do you think has made you successful as an investor over the long term?
Over the long term, it's been not getting caught up in the noise, not being a victim of the distractions that are happening every day. Well, how do you stay away from the distractions? Well, that's the hard part, you know. The hard part is really, you know, our discipline is value investing. It's concentrating on the value of individual companies. And yes, we hear the bombardment every day of the noise of the Trumps, the elections, the the dislocations internationally, but at the bottom line, it's what is the company you're investing in? How are they positioned? What are they doing? And how in that environment are they going to profit? And more importantly, what are you paying for that?
Exactly. Well, Michael, thank you for your time again.
Thank you very much.